If you think silver's price tells you who controls it, you're already late. Right now, silver's chopping sideways. Mid-20s, boring, same story for months. Industrial demand, screaming. Solar installations up 40% year over year. EV battery content climbing. AI server racks pulling silver by the ton. Yet price barely moves. Here's what you're not seeing. While retail got warned off, one institution quietly amassed the largest COMEX-linked physical silver position in modern history. JPMorgan. Over a decade. Roughly 800 million ounces through various channels. And their futures positioning? Just flipped bullish. If you're stacking physical, watching premiums spike, or trading volatility, this matters. If you're watching now, you're ahead of the headlines. Your job isn't to predict the squeeze, it's to understand the valve that's been controlling price while metal drains from the system. I'm about to show you exactly how it works and what signals tell you it's about to stick. Before we go further, subscribe. This channel exists to map patterns the crowd misses. We watch flows, not headlines. If that's your approach, you're home. Drop flows in the comments if you're tracking this with us. Let's build the group that sees it early. Now, why does this matter more than another silver theory? Because the mechanism is simple, repeatable, and currently under maximum stress. Here's the surface. Silver's trading like it's calm. Futures volume steady. Options skew flat. Sentiment? Meh. Here's beneath. Registered COMEX silver. Metal available for immediate delivery. Dropped over 60 million ounces in the past year. That's roughly 30% of the deliverable stockpile. Lease rates, which spent a decade near zero, spiked to multi-year highs last quarter before settling. Shanghai premiums over London, running 8 to 12% for months. That's not normal. That's tension. Industrial buyers aren't waiting for dips. They're locking supply. China's tightening export quotas on refined silver. Europe's scrambling for non-Russian metal. The US solar build-out needs roughly 180 million ounces annually by 2027. And through all of this, JPMorgan, who operates as a primary COMEX liquidity provider, who ran massive short positions for years, now sits on a physical hoard comparable to entire national reserves and has shifted futures exposure toward rising prices. Think about that. The entity with the deepest insight into paper positioning, with the infrastructure to deliver or receive metal in size, with decades of experience managing volatility around COMEX expiries. That entity has quietly moved to the long side, while the public narrative stayed bearish. Price didn't move because pressure was vented elsewhere. You're about to learn where and why it can't last. Let me name the mechanism simply. Paper flood, physical drain. Here's how it works. Imagine a valve between two systems. One system is paper, futures, options, ETF creation units, synthetic exposure. The other is physical, bars in vaults, deliveries, industrial consumption, jewelry fabrication. When physical demand rises and threatens to spike price, the valve opens. Paper volume floods the market. Futures liquidity increases. Volatility gets sold. Price discovery happens in the paper layer, where supply is theoretically unlimited. As long as most participants settle in cash, the system stabilizes. Meanwhile, physical quietly drains. Deliveries happen off-screen. Industrial buyers negotiate premiums directly. Lease rates tick up as available inventory tightens, but lease markets are opaque. Retail doesn't see them. Registered stockpiles fall, but unless you're checking daily COMEX reports, you miss it. The metal leaves the system while price says everything's fine. This isn't conspiracy, it's structure. COMEX exists to provide price discovery and liquidity. Futures are designed for hedging and speculation, not physical settlement. Most contracts expire without delivery. That's normal, that's how it should work. But when a dominant liquidity provider, someone who can sell futures in size, deliver physical, if called, and absorb volatility spikes, uses that infrastructure while simultaneously accumulating the underlying asset, the valve becomes a lever. You stabilize the paper price, you control volatility around expiries, you prevent premature moves that would pull in momentum buyers. And the whole time, you're increasing your position in the thing that actually matters, the metal. Why does it repeat? Because the incentives never change. Industrial users need silver today. They can't wait for $40. Speculators chase volatility, not basis. Retail stacks when excited, dumps when bored. And institutions with balance sheets, infrastructure, and information asymmetry can play both sides, provide liquidity, earn spreads, accumulate physical, manage risk. It's beautiful if you're inside, brutal if you're not. Current application. We're watching it happen in real time. Silver futures volume stays elevated, keeping price range bound. But registered inventory keeps falling. Lease rates spiked hard in Q3 2024, signalling tightness, then eased as metal was borrowed into the market. Shanghai premiums persist, meaning Asian buyers are paying significantly more for immediate delivery than paper suggests it's worth. And the largest player in this game, JPMorgan, has now positioned for higher prices after spending years on the short side. When the valve sticks, price doesn't trickle, it jumps. Circle this. The mechanism only works while physical remains available to deliver, and while speculators stay disinterested. Remove either condition and the valve breaks. Now let's layer in the second pattern. Position flip trap. This one's about timing and narrative control. Here's the setup. A large, sophisticated player runs a net short position for years. They provide liquidity. They stabilize volatility. They profit from range-bound conditions and time decay in options. The public sees this positioning and assumes they're bearish. Why would they be short if they expected higher prices? But quietly, they're doing something else. They're accumulating physical, through deliveries, through off-exchange purchases, through private transactions with miners or refiners. The physical hoard grows while the paper position stays short. No contradiction. It's a hedge. You're short paper, long physical. If price rises, your physical gains offset paper losses. If price falls, your short profits fund more physical accumulation at cheaper prices. You win both ways. Then, at some point, maybe because industrial demand accelerates, maybe because available inventory thins, maybe because macro conditions shift, you flip. You cover shorts. You go long futures. You shift from suppressing volatility to benefiting from it. But here's the trap. The public doesn't know yet. Your positioning change happens in reports that lag by weeks. By the time retail sees the data, you're already positioned. The narrative is still bearish. Sentiment is still subdued. Premiums are rising but slowly. Volatility is still being sold. Then something breaks. Maybe it's a larger than expected delivery demand at expiry. Maybe it's an export restriction announcement. Maybe it's a scramble for physical that overwhelms the available registered stockpile. Doesn't matter what. What matters is that when the narrative flips, you're already on the right side. Retail panics in. Momentum algos trigger. Short covering cascades. And the entity that spent years stabilizing price is now riding the move they engineered. Imagine you're an industrial buyer. You need 5 million ounces for Q2 production. You've been watching COMEX price, thinking you'll buy the dip. Then you call for delivery and hear, registered inventory is tight. We can deliver, but there's a 10% premium and a 6-week delay. Suddenly, paper price is irrelevant. You're bidding for physical. Now multiply that by every solar manufacturer, every EV battery plant, every electronics fabricator who assumed silver would always be available at spot, plus a small premium. They all hit the bid simultaneously. That's when the valve sticks. Watch who benefits from calm. Not telling you this is guaranteed, showing you the structure. JPMorgan's positioning shift doesn't mean they know what happens next. It means they've managed risk in a way that benefits from higher prices while maintaining optionality. They could be wrong. Markets could stay irrational. Paper could flood harder and extend the range for years. But the physical drain is real. The industrial demand is real. And the entity, with the most information, just repositioned. Your job isn't to front-run JPMorgan. It's to understand what conditions would make their bet profitable. And watch for those conditions in real time. Here's what you need to sit with. The question isn't, is silver manipulated? That's the wrong frame. Manipulation implies breaking rules. What we're watching is legal, structural, and repeatable. It's how futures markets interface with physical commodities when one entity has asymmetric resources and information. The real question is, what happens when the mechanism runs out of slack? Because there are only two paths when the valve sticks. Path 1. Sudden repricing. Price gaps to a level where physical supply and paper demand rebalance instantly. Think 20% overnight. Industrial buyers adjust budgets. Speculators chase. Momentum feeds itself. Registered inventory stabilizes because higher prices ration demand and pull in recycling supply. Path 2. Managed rationing. Price rises but controlled. Premiums widen instead of spot spiking. Lease rates stay elevated. Deliveries get delayed. Industrial users pay more but get their metal. Retail gets priced out. The system adapts slowly, preventing panic, preserving infrastructure. Which happens depends on variables we can't control. Industrial demand trajectory, Chinese export policy, speculator appetite, ETF flows, regulatory shifts. But both paths require the same trigger. Physical availability drops below the threshold where paper derivatives can credibly promise delivery. We don't know where that threshold is. We just know we're closer to it than we've been in decades. Could reverse. Always could. A recession could crater industrial demand. China could dump stockpiles. Substitutes could emerge faster than expected. Mining supply could surge if price breaks higher. Not predicting. Watching signals. Let's map scenarios, no guarantees, just frameworks. In the first scenario, the slow grind, industrial demand stays strong but not explosive. Registered inventory drifts lower but doesn't crash. Premiums stay elevated, 5 to 15% over spot, but don't spike. Price grinds higher over 12-24 months, mid-20s to mid-30s. Who wins here? Patient physical holders, miners with production, options buyers with long-dated calls, industrial users who hedged early. Who loses? Shorts who fight the trend, retail who chases headlines late, traders who overlever near-term moves. Second scenario is the sudden snap. Delivery demand overwhelms registered supply at a major expiry. Price gaps 15-25% in a week. Premiums explode. Volatility spikes crush option sellers. Momentum algos pile in. Industrial buyers scramble. Who wins? Physical holders. Long gamma traders. Anyone positioned before the move. Who loses? Short sellers. Volatility sellers. Late chasers who buy the top. Third scenario, the managed reprice. Dominant players widen bid-ask spreads, raise premiums, and control the repricing over 6-12 months. Price rises but never panics. Retail participation stays subdued. Institutions accumulate quietly. Industrial users adjust but don't panic. Who wins? Large physical holders. Entities with delivery infrastructure. Spread traders. Patient accumulators. Who loses? Those waiting for a better entry. Momentum chasers. High leverage short-term bets. Not calling which, showing what to watch. So here's what we're tracking together. First, COMEX registered silver on a daily basis. Normal behavior looks like inventory, drifting 1 to 3 million ounces per week. Fluctuations around deliveries, then stabilization. Stress shows up as drops of 5-10+ million ounces in a week, with no corresponding increase in eligible or persistent one-way declines over months. You can check this through CME Group daily delivery reports, aggregating registered across all COMEX warehouses. The logic is simple. Registered is deliverable. When it drains without replenishment, the physical buffer shrinks. If it drops below roughly 100 million ounces, we're in historically tight territory. Second, silver lease rates and spot future spreads. Normally, front-month lease rates stay near 0.1%, with contango of 0.52% annually between spot and 12-month futures. Stress looks like lease rates spiking above 3-5%, or backwardation emerging where spot trades at a premium to futures. This signals immediate demand outpacing supply. You can check Kitco, Bloomberg, or LBMA lease rate data, though it's delayed but directional. The logic here is that when borrowing physical costs more than holding it, the market is screaming for metal today, not paper promises for tomorrow. Third, Shanghai versus London and New York premiums. Normal is Shanghai spot within 1 to 3% of London, and New York, reflecting transport costs and local demand, nothing alarming. Stress is Shanghai premiums exceeding 8 to 10% persistently, meaning Asian buyers can't access sufficient supply through normal channels and are bidding aggressively for available metal. Check the Shanghai Gold Exchange silver data versus LBMA spot. The logic is that geographic arbitrage should equalize prices. When it doesn't, something's restricting flows, export quotas, supply bottlenecks, or hoarding. Fourth, options skew near front-month expiries. Normal is an implied volatility curve that's relatively flat with balanced put-call interest. Stress shows up as call skew steepening sharply, out-of-the-money calls getting bid aggressively, and put-call ratios favouring calls 2.1 or higher. Check CME options volume and open interest reports, or bar chart for retail-accessible data. When smart money buys upside protection heavily, they're pricing in potential squeezes or delivery issues that aren't yet visible in spot. Fifth, policy headlines around export controls and industrial subsidies. Watch for Chinese export quota announcements, US or EU critical minerals policy, solar subsidy expansions, or EV battery supply chain executive orders. The logic is that policy shifts create physical flow restrictions or demand surges that futures markets can't arbitrage away instantly. Here's how we think about all this. Stack signals. One indicator alone means nothing. Registered drops plus lease spike plus premium surge equals pattern confirmation. Avoid narratives. Silver's breaking out or manipulation ending are stories. Watch the data, not the drama. Respect liquidity. The valve mechanism works because paper liquidity is deep. Don't assume it breaks just because fundamentals say it should. Think about risk in clusters. If you're holding physical, accept that price might chop for months before moving. Volatility comes in bursts, not steady trends. If you're trading size positions for gap risk, this isn't a market where stops protect you reliably. If you're accumulating, diversify entry points. Average in, don't hero buy one level, and timing humility matters. Can't know when the valve sticks. Only that stress is building. If you're watching the valve instead of the headline, you put yourself in the group that sees it early. Not the group that buys the top after CNBC covers it. Not the group that panics when premiums explode overnight. The group that understands structure, tracks quiet signals, and positions accordingly. We just walked through two mechanisms: paper flood, physical drain, and position flip trap. You've seen how dominant players stabilize price while accumulating the asset. You've seen why the largest COMEX-linked entity flipping bullish matters more than it should. You've got a watch list, registered inventory, lease rates, premiums, options skew, policy shifts that tells you when stress is building. Now it's your job to watch. Not advice, pattern recognition, not predicting timing, understanding structure. Could reverse, always could. But if you're holding physical, if you're stacking deliberately, if you're trading volatility around this setup, you're now tracking the signals that matter. One question for the comments: what are you watching more closely? Physical tightness or paper calm? Drop your answer. Let's see where the community's focus is. And if you caught something in your local market, premiums spiking at your dealer, delivery delays on larger orders, anything tangible, share it. We learn faster together. Subscribe if you're not already. This channel maps patterns the crowd misses. Next video, we're breaking down copper's similar dynamic and why the valve there might stick first. Final insight. Control shows up in flows, not quotes. The price you see on your screen is the valve's output. The metal leaving warehouses, the premiums industrial buyers pay, the positioning shifts in derivatives. Those are the inputs. Watch the inputs. You'll see the output before it moves. Links below for COMEX, registered data, lease rate trackers, and premium monitors. Tools, not theories. See you in the next one.